Before you start trading options, it's important to understand what they are and how to use them in different market conditions. We're going to use some common options terminology in this lesson, so if you need a refresher on the basics, check out our video on option terms first. But if you're clear on the lingo, then let's go. There are two types of option contracts: calls and puts, and each option trade has a buyer and a seller. Here, we'll learn about calls from a perspective of a buyer. Remember, a call option is a contract that gives a buyer the right or choice to buy the underlying stock at the strike price on or before the expiration date. Buyers are also referred to as going long the option. The price of an option contract is mainly determined by the price of the underlying stock, but it's also influenced by other factors, such as the amount of time left until the option contract expires and how volatile the underlying stock is in trading. Let's focus on that price dynamic first. We'll dig into the roles that time and volatility play in another lesson. So for calls, the price of the option contract moves in the same direction as the underlying stock. In most cases, if the price of the underlying stock goes up, the price of the option does too. Traders buy call options when they believe the underlying stock will rise. And since a stock can go up indefinitely, their maximum profit potential is unlimited. Let's look at an example. Keep in mind, this example doesn't include commissions and other fees. Ensure you understand your broker's fee schedule before trading options. An option trader named Jack buys a $35 call when the underlying stock is trading at $30. He pays $1 for the option that has a multiplier of 100 for a total premium of $100. Then the underlying stock climbs to $40 and the option is worth $500. But why is that? Because you now have the right to buy a stock that's worth $40 for only $35, a difference of $5 per share. And remember, the standard deliverable is 100 shares, so the net value is $500. In real life, if there's quite a bit of time before the option contract expires, then the premium is likely well worth over $500. But we'll stick with a value of $500 for simplicity's sake. Now, Jack has a decision to make. Should he just sell the contract for the profit? Or does he want to exercise his right to buy the shares at $35 apiece? Let's examine both choices. He can sell the option for $500 and lock in a profit of $400. Remember, Jack paid a premium of $100 for the option, so we need to add that to his total cost. Or he can exercise his option and buy 100 shares of the underlying stock for $35 per share, which costs $3,500. So that means his total cost is actually $3,600 or $36 per share, plus whatever applicable commission fees he would need to pay. A shortcut to determining Jack's break-even is to add the price of the contract traded for, $1, to the strike price, $35. Keep in mind that Jack must also ensure he can afford to buy the 100 shares if he decides to exercise the option, meaning he needs to have enough cash or margin available in his account at the time of exercise. Now you might be thinking, why might Jack exercise the option instead of just selling it and capturing a profit? Well, Jack might exercise the option if he thinks the stock will continue to increase in value past the option's expiration date. So that's what happens if the underlying stock price rises. But what if the underlying stock falls or doesn't move at all? Well, Jack can decide to let the option expire and lose the $100 he paid as the premium. This is called his maximum loss. Or Jack can sell the option before it expires, realizing a smaller loss. So let's recap what we've learned about buying a call. Call buyers want the underlying stock to go up. Their break-even point is the premium they pay plus the strike price of the call. Their maximum profit is unlimited. Their maximum risk is the premium they pay to buy the call. But what kind of option trade can Jack make if he doesn't think the underlying stock will go up? For that answer, watch our other lessons on calls and puts.